Hi, my name is Daniel Brown and I'm the CEO of Myriad Real Estate Group. Today I'm joined by Garret Cerkvenik, who is a loan officer with Lendplicity Morgage based here in Phoenix, Arizona. And today we are going to talk about ARMs, or adjustable rate mortgages. All right, Garret, let's get it started. So tell us a little bit about adjustable rate mortgages.
So, pretty simple, beyond that, it's an adjustable rate mortgage. Most people are familiar with, a fixed product or traditionally a 30-year fixed, right? That stays the same the entire term of the loan. And an adjustable basically has a fixed period up front, could be any number of years, 1, 3, 5, 7, 10. And the rate stays fixed for that period of time. And then after that, it can adjust with the market. So as simple as possible, that is it.
Yeah, so I think over the last 10 to 15 years, most people have been fixated on 15 and 30-year fixed mortgages because the rates have been relatively low. Pricing for homes was relatively low, and we got into a heap of trouble in 07, 08 because of adjustable rate mortgages were a large part of that.
Yeah.
So tell me a little bit about why adjustable rate mortgages or ARMs might be something that someone should be interested in today.
Okay, so starting off with the difference of what happened in the last crash, what everybody remembers. Adjustables back then, they had a lot of differences. You had things like really short fixed periods. So some adjustables would be 6 months, for instance, and then your rate would start to adjust after that. Some a year. And really, with the market changing as quickly as it does sometimes, that can really have an impact on people's payments. They were used in a lot of cases to qualify borrowers that maybe didn't make enough money to begin with. And it started off with a very low payment. So if you have somebody that's on the edge of qualifying and you're qualifying them on a payment here, and then after 6 months, it starts to adjust up, that's going to, obviously going to cause some issues and create a financial strain on that buyer. So these days, ARMs are mortgages in general are a lot more standardized. There's very few, they're a little bit more vanilla. But the ARM products, have typically longer fixed periods. The most common ARMs right now are 5, 7, and 10-year ARMs. So you really are getting a really long time in that initial period. That's going to give you, a better interest rate, a better payment, and keep it fixed in for however long you choose to fix it in.
So right now it's April of 2022, and this year we have seen home prices continue to skyrocket. And now all of a sudden, I did videos in January and I laughed because I was predicting that mortgage rates on a 30-year fix would be above 4% by the end of the year. Now I wasn't wrong, but not in my wildest dreams that I think would be above 5% at the end of April. So, the reason we wanted to kind of do this video was to talk about why ARMs might be an attractive alternative with these higher rates and these higher prices. So can you dive into a little bit on what you mean by 5, 7, and 10-year ARMs? Like, break down for us what that means.
So the 5, 7, or 10 is the fixed period for the loan. So if you're doing a 7-year ARM, your interest rate is fixed for the first 7 years, and then it can adjust after that. Still based on a 30-year term, so that's what your payment is based on, but that refers to the fixed period on the loan.
And so is the rate based on what rates are today? So if a 30-year fix today is just above 5%, if I'm doing a 7-year ARM, am I at just above 5%, or is that rate lower?
So the rates typically are lower.
Okay.
In the last couple of years, there really hasn't been a big market for ARMs. Fixed products have been so low that, ARMs just really, there's been no benefit for them. But as we get into these higher interest rates and as the market continues to change, I think it's a product that's going to start coming back. Right now, the ARM products that I'm seeing are usually anywhere from 3/8 to about 0.5% cheaper than a 30-year fixed. So not a huge difference between the two, to where I'm still not quite recommending them to a ton of people, but it is a difference. And I think that gap is going to get bigger the farther we get into this ever-changing market.
When the rate adjusts, does it adjust at whatever the 30-year fixed rates are at that time?
No. So you have what's called an index, you have a margin, and that kind of determines what your rate's going to be when it adjusts. So let's say your index is 1 and your margin is 2.75. When things adjust, your rate would go to a 3.75. Now, if that index is 2, when it adjusts. Now your rate's 4.75.
Do you know what that is at the time you sign, or is it you don't know how expensive it could get at the end of that term?
So you know what your margin is going to be. So you know what that is, and then you can see today what the index is, but you don't know what that index is going to be
in the future.
And that's kind of the gamble with the ARM. Now there are caps in place. So typically ARMs can only adjust so much per year. So you may have a 2% cap per year, to where if you start off at a 4%, and let's say your index goes up through the roof, the most your interest rate can adjust that first year is going to be 6%. But it can adjust after that every 6 months or every 12 months, and could adjust up another 2%.
And this is at the end of your term, whether it's 5, 7, or 10 years.
Exactly.
And so the reason that I like ARMs is a couple of things. Is first off, most people sell their home every 5 to 10 years. Very rare are people in their home for 30 years.
Yeah, correct.
So over the last 10 years, and especially over the last 2, it's been great to lock your rate in between 2 and 3% for 30 years. That's awesome.
Yeah.
Going forward, most of us aren't going to have that opportunity. And so with ARMs, it makes your monthly payment that much more affordable for something that you're probably only going to be in for 5 to 10 years.
I agree. And, real quick, while people are only in their homes for, say, 5 to 10 years, I see on my end, most people are only in their mortgages for 3 to 5 years.
Well, and that was going to be my next point, is rates are going up pretty fast right now. In my recent most market prediction that I did, or market update for this month, I think that the U.S. is probably headed for a recession in the near future, whether it's this year, next year, or the year after. I think the Fed is going to have a really hard time doing what's called a soft landing, where the economy is continuing to grow, but they also bring down inflation. I don't see them doing that. I think that they're going to bring down inflation and then also cause a recession. So when a recession happens, we see rates go down because the bond yield comes down, so therefore rates come down. So I think we're probably going to see a mini refi boom in the next 1 to 3 years probably. So if you do an ARM and take advantage of it now, you're probably going to have an opportunity to refinance here in the next 1 to 3 years when rates start to come back down.
I agree. And even if that wasn't the case, there's all kinds of reasons that people refinance, right?
Sure.
It's not just rates coming down. People need to pull cash out because they have a kid going to college in 5 years. They, want to do home improvements. They sell their house, whatever it may be. People just aren't in their mortgages for a long period of time. And so, now it does make you feel nice, warm and fuzzy to lock it in for 30 years, but you're paying a premium for that. A 0.5% on a $500,000 loan is $150 a month. So it's $1,800 a year. It's $9,000 over the first 5 years. So, it's a sizable chunk of money that you're going to pay just to have it locked in for a period of time that you probably aren't going to need. When somebody calls me, one of the things I ask them is, what are your long-term goals for this house? And most people say, well, we plan on staying here for a long time. And I start asking other questions about, kids and, is this a fixer upper? Are you eventually going to want to pull some money out? Because I may recommend an ARM to that person. Now, if you've got somebody that says, listen, I'm going to buy this, I'm never moving, I'm never going to leave this more, I don't want to refinance, I don't want to do anything, then I'm going to recommend a fixed product. But it's really case by case on, on when I'm going to, offer this to somebody and really push it.
So are the down payments for ARMs the same as for a 15 or 30 year?
Yep, same qualifying process, same debt ratio, credit requirements, down payment requirements. Really the big difference is just losing that fixed for the term, and then picking what term is going to work for you. On my house, I have a 7 year. Five is a little shorter, but 7 years is great because the pricing is very similar. A lot of people choose a 10. 10 years is a long time to be fixed in on a mortgage. So
is there longer ARMs than 10?
I have seen some 15s. There's not a big market right now. The big ones are 5, 7, and 10, and that's what you're going to see in most markets these days.
So say you're in an ARM and you're wanting to refinance it to lock in the rate, or you're pulling money, like whatever the case may be. Is it a harder process to refinance out of an ARM than a traditional mortgage?
Nope. You just got to evaluate whether or not it makes sense. There are some scenarios where your interest rate's going to go down, right? So it may not make sense to do a refi. You could get to the end of your ARM period and your rate could shrink, and so why would you want to lock it in at that point? Or maybe that is the time to lock it in. Maybe you don't quite get as low of an interest rate as if you just let it adjust, but you're still getting into something that's fixed going forward from that period. So
Well, I think to kind of summarize this is that the ARMs that exist today are not the same ARMs that our parents used leading up to the housing crisis in 2008. And, they're not for everybody, but they are a good alternative and a good, potential solution to help with this affordability problem that we're having in an environment where rates are going up pretty rapidly.
Correct. And I think that, again, they aren't for everybody, but it's something at least just to ask about. When you're talking to your lender, ask them what the pricing looks like and evaluate, your situation. Everybody's different, see if it's something that's worthwhile to you to lose that fixed product.
Perfect. Well, thank you so much for educating us today on ARMs. If you guys have any questions, please leave them in the comments. We'll make sure that we put Garrett's contact information in the notes as well. Thank you guys so much for tuning in, and we will see you next time.